Afternoon, everyone. Here's a look at our May 25th video lesson. Hope everyone enjoyed the long holiday weekend with friends and family. This is going to be a two-part video lesson series of my first 10% drawdown since launching Summit Report. So just to zoom out, the whole goal of Summit Report is publicly trading a $15,000 account to 100K. Along the way, there's bumps, trading, nobody's perfect, you make mistakes. And what I've found in my 10-year career is you learn more from the mistakes than the wins. So just taking a look here at the week, there is a happy ending to this story, but what I want to focus on is this drag down here, down to 20,600, roughly 10-11% drawdown. And really what mistakes that I made to cause this. And, in part two of the video lesson, we'll take a look at the bounce back to new highs and the adjustments that I made. But for this one, let's focus on the ugly, kind of zooming out from positions I was taking on Thursday, Friday of last week, the 14th and 15th. You could see here that 8-trade losing streak. I'm fully transparent when things go right. I'm fully transparent when things go wrong. And just to reiterate, you learn more from losing trades than you do with winning trades. So yeah, roughly a 10% drawdown. I treat this 15K account like I'm trading full time. When I trade full time, it's a $50,000 account. So a 10-12% drawdown in that's losing $5,500 in just a few days. So this drawdown certainly affected me the same way a larger account drawdown would. And I'm also trading publicly. So I want to give you guys winners just as bad as I want, this account at 100K. So really kind of like just the moral of this before we dig into each trade is why position sizing is so important. I had eight losing trades in a row, average loss of 223, about an $1,800, $2,000 drawdown when you include intraday action. And a lot of these, it could have certainly been a lot better of a drawdown, maybe only 7%, 6% if I stuck to my rules, and it certainly could have been a lot worse. So let's take a look here at MSOs. We got long this on the 14th. I sold on the 15th. This was the ugliest trade of the bunch. I lost about 7% on it. But here you could see the position sizing, 1,000 shares at 484. So this was like an 18-20% position. Here we are taking a look at the MSOs daily. So I got long Thursday, basically expecting this range to hold up as like a triple bottom, move back towards 520. And here's the candlestick on the 15th where the exact opposite happened, total nuke town, and I got caught up in a retail trap. So let's take a look here at the 10-day, 30-minute, just having a look at Thursday to let's call it Tuesday's price action. Here's 471. This was a level that I was expecting just to continue holding as support. We got long kind of towards end of day at 487. I'm looking, I'm like, okay, 470s are going to hold. Friday, the exact opposite took place, fighting to hold on to the 470s. Here you could see that 471 level, which was my risk on the trade, broke down and it took the elevator down. We went from 471 all the way down to the 450s. We were fighting to hold the 450s and then total nuke down into the 430s. So on this trade, my entry was 484, my risk was 471. I got emotional and was like, oh, this is going to hold, it'll bounce back. And obviously the inverse happened. So something that should have been a 2 or 3% loss turned into a 7% loss. And this was just solely off. I had a lot of trades going wrong. I got a little bit emotional and, attached to the stock. And this drawdown, right, this 2-hour period of selling, I should have just cut immediately and I didn't. And this was just bad. What happens when you don't stick to rules? Again, zooming out, 470s, that was the key level to hold up. It didn't. I didn't cut my losses, and it cost me an extra $150. So there's a reason for these rules. I've taken haircuts of $5, $10, $15,000 on trades, and it's like a kid touching the stove. You got to find out that it's hot. You got to burn your hand a little bit before you learn not to touch the hot stove, and the same thing goes with trading. So MSOs, like, I grade this trade as an F because I was undisciplined, didn't cut losses quickly, and even though it was a small position size, it was one of the biggest losses of the period. So just goes to show what happens when you're undisciplined. Losses intensify, and then you kind of get into I have to make up these losses mode, which is very dangerous as a trader. The next trade we're going to look at here is Keel. So I have 2 lots. It was a very oversized position Thursday, Friday of last week. I like being cash over the weekend so I can chill out and not follow news events. So this was a $2,500 position at 440, roughly 48% of my account. So I kind of called this Cowboy Connor, just oversizing position, not sticking to basic rules, and I paid for it. This was a $630 loss. Our first block that we sold Keel was minus 7.8%, then minus 4.5%. So we'll start here on Keel with the daily. One of the other mistakes I made here is I just fell in love with the stock. I have a big position here. We ended up coming back and doing well on the trade, but I was undisciplined, kind of fighting a trend. So here we take a look at the 14th. As you can see, overall, Keel's in a massive uptrend. We're going to be back for more. This is a great stock, something awesome to own long term. But here we are. Let's take a look at the 14th. We had a huge spike from 405 to 465. I got long on the 15th, basically expecting this uptrend to continue. And instead, I got hit with this massive candle on the 18th of a total dump down. So let's take a look here at 10-day, 30-minute, just so you can kind of see what my thought process was. Here's Thursday. Before we were long, we saw the huge move to 465. On Friday, it dragged down, and that's when I got long. And instead of just cutting and re-entering, I decided to stay long, which was certainly wrong. So I was long at 456 and 440. So, the high on Thursday was 465. We dragged down to 422. I got long kind of in here and as well on Thursday, and I was like, hey, we're going to spike right on back. Monday rolls around, which is the 18th, so this was when I sold. We had the pre-market run up to 465 again. I did have an opportunity to sell, get out of the trade for a small gain, but this is kind of when emotions get involved. I was like, hey, we're going to be fine. It's going to break 465 and turn into a really good winning trade. And once again, the inverse happened. So got caught on the wrong side of this move. Nuked down from 450s all the way down to 397. So, this time I was a little bit better at cutting losses. We got out in the 420s. But on this first 750 share block, that was a 7.8% loss. Like, my rules are 3 to 5%. So I not only oversized the trade, but I was undisciplined with getting out. I could have gotten out for a small gain. Instead, I got out for a $650 loss. So we cut here. And as you could see on this 30-minute candle, I had an hour to get out for break even or a small loss, and I was just undisciplined, not locked in, and it's certainly just a part of trading. Professional traders make these mistakes all the time. Billionaire investors make mistakes on their longs. It's about being transparent and learning from the mistakes. So with this being an oversized position, I should have been selling pre-market, like cutting. I was long a total of 2,500 shares. I should have cut half right in here for break even or a small gain, and then played the last 1250. Again, should have been cutting earlier. I fell in love with the stock a little bit, got emotional, and you pay. So that was the Keel trade, just, really undisciplined with the oversized weekend position. Ultimately got the move I was expecting, but that's the difference between trading and investing. If you went long here as an investment with a longer investment horizon, you'd be fine and green. Trading, oversized position, shorter term time frame, these candlesticks can nuke you, and those losses could add up and eat a trading account. So 2 clear rule breaks here. MSOs was not cutting on defined support. That cost me an extra 150. Keel was just like a cowboy oversized position, and I was undisciplined with cutting losses. So just between these 2 trades, minus $1,000, and on a $22,000 account, that's 5% drawdown right there. And what frustrated me the most of this drawdown was like very, very simple mistake, like rookie mistakes. Don't oversize your weekend longs, cut at defined levels. And I kind of just broke a lot of my trading rules, and you see what happens. We'll have a look. We'll skip SoFi and come back to it. Small loss, but it's more so the lesson to take from it and the principle of the loss. But let's take a look here at Iron on the 18th. This one I did a good job. Our defined risks on most trades is 3 to 5%. This was a 4.8% loss. Basically, I had all these losses, and I was like, okay, time to stick to my rules. So we did good on Iron on the 18th. Let's take a look here at Iron's daily. So on the 15th, 18th, this is where we went long. So what I was looking at was let me find it, the 18th. 15, 18. I was looking for basically this level to hold at 53, 52. The opposite happened. We dragged all the way down to 47. So take a look here at a 10-day, 30-minute. This was like a Friday, Tuesday trade. Once again, we did catch the bounce, but we'll highlight that in part 2 of this video lesson. But here you can see on Monday, just kind of Nuketown getting, way beat down. Iron, we got long at 54.69 and we got out at 52. So position sizing was good and I stuck to my rules. But again, I was kind of fighting an overall trend. I got long in here on Friday. This was another weekend long. We had a pop up to 54 and then Bajang total Nuketown. So on Iron, I sold at 52. So that was great. That was a great sell. Like the trade wasn't working out Monday morning. I had other losses that were adding up. We got out and subsequently the stock went all the way down to 46. So I got out at 52 instead of 46. That's an $8 difference. So this could have been a $1,000 loss instead of a $267 loss. So, kind of compare what I did correctly on Iron versus what I did incorrectly on MSOs. Cutting losses quickly is, the number one most important rule in trading, especially my strategy where it's like the target risk is 3 to 5%, target upside 10 to 15. I could be wrong 5 times and be right once and it washes away the rest. So really just kind of compare and contrast. 7% loss, 4.8% loss. And again, this was another, heavy size position. I was like 45% Keel, another 30% Iron, 28% Iron. So bad trade. Good trade here of being disciplined, cutting losses. Bad trade in the sense is I was just fighting a trend a bit. I was just very hopeful that this 53 level was going to hold up as support. Ultimately, big breakdown. But again, we cut at 52. So just zooming in here, we cut here in this candle at 52, and look how much worse it got. Like, by being disciplined, cutting your losses quickly, you avoid being a part of moves like this. And, kind of taking things back to MSOs, when you aren't disciplined and you don't stick to the rules like I didn't do on this trade, we are a part of these big washouts, and that's when losses add up. I was fortunate that my position was only $4,800, where this 7% loss wasn't, too bad in the grand scheme of things. But, I'm someone who, believes in just focus on the principle, and certainly something went wrong there. Keel, we're going to have a look at the 19th. So this was another trade kind of like Iron, where I stuck to my rules. Keel, taking a look, 18, 19. I was basically just dip buying this for this larger move that came up into the fives. Part 2 of the video lesson will highlight the bounce back, but let's focus on what went wrong. So sorry for that. Go back to the 10-day 30. So this was the 18th. So we'll just have a look here at like Monday to Wednesday action. We washed down to 396. Bounced back pretty good. I got long at 412. I think I opened this trade on the 18th. I closed it on the 19th. So again, 1,400 shares, a little bit of a larger size. That's like $6,000. So like a 33% position on Keel at 412, and the inverse happened. We briefly had a move up pre-market, and then bushing, here's the wash. I closed this trade at 397. Again, focus on the percentage. This was only a 3.64% loss. So compare that to the 7-8% I lost on Keel. Compare that to the 7% I lost on MSOs. This is the range we want to be playing in. Smaller losses, not these 7-10% losses. So did good. 397 is where we got out. I was kind of protecting myself against a larger wash. You look at the daily here. If 389 didn't hold, we could have gone down to the 370s. So played this one safe. We cut, we got out, we moved on to the next trade. And then, kind of sneak peek ahead, 12% bounce back of $2,500. So, we'll highlight the good stuff in part 2 of this video lesson, but, it's good to focus on the ugly. There are clear rules that are being broken, and that's the reason for the loss. And before we close out this video, just want to take a look at this SoFi trade on the 18th. This was just dumb. I was 0 for 7, and I was like, hey, let me get a quick winning trade. And this is the whole chasing gains kind of thing. As you could see, SoFi just been beaten down, stuck under 16 for a while. A stock I'm bullish on long term, so I was, kind of hoping we get a bounce here at least to the 1670s. Trump's 13F came out with everything he was long. SoFi was in the bunch. A lot of his SaaS positions were bouncing, so I was just expecting a move there. Let's take a look at the 10-day 30. This was a Monday trade. So we had the big spike to 1630s, then it started pulling back. That's when I went long on Monday, where I was just hoping for follow-through for that 16 level to finally break and flip into support, where we could have gotten a move towards 17s or maybe even a gap fill. So it was kind of breaking some of my trading rules with being, patient on entries. I got long at 1590. I sold it overnight at 1565. So it was only a 1% loss, $80, didn't really matter. But this just goes to show where you can't force trades, you can't chase gains, and that's sort of exactly what I did here. getting long for the other move, and then boom, I got trapped in the trade. And here you could see overnight 1570s, and I dumped at 1565. So I got lucky where there was a little bit of a bounce into the bell. I got out, and again, why we cut losses quickly. On Tuesday, it subsequently flushed from 1560 all the way down to 14.9. So, good trade in the sense of getting out of a position when it's not working. It was a 27% position, so good size. I was just forcing a trade, not trading the right setup. But if you're not careful, you be a part of these dumps, and those losses start to intensify and snowball, which could ultimately, destroy your small brokerage account. So, all in all, 8 trade. It's in the grand scheme of things, it's not that bad of a drawdown, but it could have been avoided by following rules that I've put in place in my trading career over the last decade. And this is what happens when you don't stick to your rules. You have bigger losses, you have bigger drawdowns, and for the average investor or trader taking these positions, you would probably be down 15-20% instead of 10%. So it just goes to show these rules exist for a reason. Stick to cutting losses quickly, scaling into winners, never averaging down. And if I was buying more MSOs at 470, this could have been $1,000 loss. Was the one rule that I did stick to here was I didn't add to losers. And if I did add to losers, this could have been a 20% drawdown and would have been a lot harder to make up. So sneak peek to part 2 of this video lesson was a $2,400 bounce back of 12%. I did that on 3 trades, all of which were over a 10% winner. And we'll dig into those trades in part 2, so be on the lookout for that.